So what's going on, y'all? This is BikerboyDee with Zamunda Profit Squad. Thank you guys for coming out here with us today to learn something and further your education. Today, what we have going on is sector rotation. It's going to be an introduction to it because there's a lot that goes into sector rotation. So first, I want to give you the basics and allow you to digest that information before we go into depth in the following class. So before you are able to understand what sector rotation is, you must understand what the sectors are, okay? So we have 11 sectors. We have XLB, XLC, XLE, XLF, XLI, XLK, XLP, XLRE, XLU, XLV, and XLY. And we're going to get into each of those individually. So first, we have XLB, which stands for basic materials. I really want you guys to know all of the sectors by heart. If you need to make flashcards or whatever you need to do to help you remember these things, I want you to do that because it's very important to know what the sectors are and not have to look somewhere to correlate what they are. It's easier to know it by heart. So I'll give you some tips how I remembered it when I made flashcards. So XLB, obviously, basic materials. XLB will be things like raw materials such as packaging, paper, metals, and companies like Lin, FCX, and they compose of 2.5% of the entire S&P 500. The next sector is going to be XLC, C for communications. That is going to be your Meta, your Google, your Netflix, things like that. XLC composes of 8.7% of the S&P. Next, we have XLE, and that's pretty self-explanatory. E for energy. Energy is going to be 4.3% of the S&P. That is going to be your XOMs, your Chevrons, your Oxys, things like that. Oils, those consist of energy. The next sector is going to be XLF for financials. Now, financials is the third leading largest sector in the S&P. That's going to be like your JPMs, your Wells Fargo, Bank of America, Berkshire Hathaway, things like that. So that is going to be your financials, XLF. Next, we have XLI, and XLI accounts for 8.5% of the S&P. XLI will be like your CAT, your RTX, your airlines. XLI is industrials. So things that consist of building, construction, things like that will be XLI. Next, we have XLK. Now, XLK is the largest sector in the S&P. This is significant because a lot of the S&P is heavily weighted on XLK. So you can get a good grasp of the market just by following what XLK is doing. XLK will consist of Apple, Microsoft, NVIDIA, and it's 28.1% of the S&P. XLK is more than twice the size of the next leading sector. So following XLK is very important to pretty much get a grasp on what's going on, which makes sense why everybody had all eyes on Apple for earnings. So next we're gonna have, and actually, I'm gonna go back to XLK. There's really no reason why it's XLK. The only thing I could that made me remember was technology. Obviously, that's not how you spell it, but when I was learning it, that's kind of what made me remember what XLK was. I just put a K in there, technology. So next we have XLP, and the way I remembered it is consumer state pulse. Once again, no reason why it's XLP. There's no actual reason why they named it XLP that we know of. But XLP accounts for 6.6% of the S&P. These will be your essential goods as far as like PG, Procter and Gamble, Walmart, Costco, yeah, things like that. These are your essential goods, the things that you can't go without. You need to brush your teeth, you need groceries, you need toilet paper. That will be XLP. Essentials, consumer staples. Next, we have XLRE. XLRE is real estate. Simple enough. XLRE accounts for 2.5% of the S&P. These will be like your Simon Property Group, SPGs, your old Realty. Now, XLRE is actually one of the newest sectors. There used to be 10. I think XLRE might be the newest addition. XLRE is very heavily dependent on what the economy is doing. So nice to watch XLRE also, even though it does not have a high weighting in the S&P. And next we have XLU for utilities. Simple enough. It has a small rating also, or weighting also. XLU will be like your Duke Energy, your Pacific Gas, and Electric. XLU is also an essential. You need utilities no matter what. So, yep, that is XLU. Next, we have XLV. Now, XLV is the second heaviest weighting in the S&P. XLV is for healthcare, and the way I remember this is CVS. So every time I see XLV, I think of CVS, and that helps me remember healthcare because V doesn't correlate with healthcare at all. So CVS is how I remember that. That's going to be your CVS, your J&J, your UNH, your healthcare. So that's what we have for XLV, and it accounts for 13.1% of the entire S&P. And lastly, we have XLY. Now, XLY, excuse me, I remember by consumer discretionary. Only way I can remember it. I don't know where they got the Y from, but that's how I remember it. So consumer discretionary, these are going to be all of your non-essentials. So Amazon, Tesla, Starbucks, pretty much whatever you spend your money on that you don't need, that's going to be your consumer discretionary. This is where they define you as a consumer. So yeah, that's the last sector, XLY, and it accounts for 10.6% of the S&P. So it is also highly weighted. As you can see, Amazon and Tesla are in that sector. Okay. And here are the top 10 weighted stocks in the S&P. So the mostly weighted stock in the entire S&P is Apple. Next is Microsoft, Amazon, Nvidia, Google, Tesla, the other Google, Berkshire Hathaway, Meta, and UNH. So you can really just keep a watch on these tickers and get a pretty good grasp on what the market is doing, or you can just trade these tickers specifically. You can find tickers that are in sympathy of these tickers, but these are going to be your most heavily weighted tickers in the S&P. These tickers can make movements of the overall market. It is important. The S&P is weighted by the companies with the largest market values. It is important to note that if a top weighted sector is performing well, it can lead the entire S&P to perform well. But if the S&P is underperforming and lower weighted sectors are performing well, that probably won't be enough to affect the entire S&P to outperform. So pretty much what that means is, let's say XLK is doing well. That's enough to hold up the entire market. But let's say the entire market isn't doing so well, but XLU is doing well. That may not be enough to have the market rebound because it's such a lower weighted sector. So that's something you want to keep in mind. So these sectors are categorized into two sections. One section is cyclical and the other is defensive or non-cyclical. Cyclical are highly dependent with the economy. So pretty much it's doing what the economy is doing. If we're in a downturn in the economy, these stocks tend to underperform. They're typically your non-essential commodities. Now, defensive stocks perform pretty evenly, pretty steady, despite the overall performance. Okay. So for cyclical, we have XLB, which is materials, industrials, financials, technology, consumer discretionary, and real estate. For defensive, we have consumer staples, turn my phone off, consumer staples, healthcare, utilities, energy, and communication. Now, why does this make sense? So for cyclicals, you have to think cyclical is highly dependent on the economy, right? So if we use an example for consumer discretionary, right? Consumer discretionary are non-essential goods. If the economy is not doing so well, you're probably not spending your money on things that you don't need, right? If there's hardship, right? We're in a recession. There's not a lot of money flow in the economy. You're probably not going to Starbucks. You're probably not buying a new Tesla. You're probably not going to buy um a new Ford or a new car. You know what I mean? You're gonna save your money because you're uncertain what the economy could hold next. Your defensive stocks would be your consumer staples, right? That consists of Costco, Walmart, Procter and Gamble. You still need toothpaste no matter what the economy is doing. You still need groceries. You still need toilet paper. XLV is healthcare. You still need healthcare no matter where we at in the economy. You still need healthcare. You still need to be cared for. There's still elderly people. People still get sick, so that's still important. Utilities, you still got to pay your light bill. They don't care what the economy is doing. You still need to keep the heat on. You still need to keep the lights on. So these three are mainly your defensive stocks. Why this is important is investors know these things. So if we are in an economic downturn, they know that money is going to be flowing out of these sectors. So what they do is they put money into more stable sectors for the reasons I just noted. XLP, XLV, and XLU, we still need these things, those things, non-depending on what the economy is doing. Those are still essentials. Now, XLE and XLC are defensive stocks, but there's actually a third category. It's called sensitive. They can be sensitive to economic change, but it's not 100% defensive. So XLE, depending on the economy, you may not be traveling as much. When life is good, the economy is doing good, the weather is nice, you might drop the top on your car and go drive around the block for no reason. When gas is $5 and it's the weather's not that good, you staying in the house. You might not be doing unnecessaries, ripping and running, as they call it. You might just be going point A to point B when you need to. XOC, XOC is a luxury, but it's something that you may not cut because of economic downturn, right? Think about Netflix. The pandemic, a lot of people weren't working even before we had financial assistance. You were still watching Netflix. You were still, on the computer and things like that. So those are things you may not cut, just because the economy is not doing well. You may find a way to factor that into your budget and still pay that. So XLE is more sensitive. XLE and XLC are more sensitive, but they are, classified as defensive. But XOP, XLV, XLU are your for sure defensive stocks. Okay. So what is sector rotation? Sector rotation is the movement of money invested in stocks from one industry to another as investors and traders anticipate the next stage of the economic cycle, and we will get into that. Investors use a sector rotation strategy to rotate their investments out of underperforming sectors into sectors more resilient to economic downturn. The investor might rotate in and out of cyclical stocks and defensive stocks depending on where in the business cycle the economy is headed. Sector rotation exercises the theory that the economy moves in cycles. So this is a reoccurring thing that happens every 5 to 10 years. And investors try to predict where we are in that cycle, get ahead of it, and take advantage of it by moving their money from one industry to the other. The economy cycle is when the economy moves from recovery to recession, then back to recovery. Stock market sectors are sensitive to different stages of the economic cycle. The market tries to anticipate what the economy is going to be doing up into the next year. So it's usually between 6 to 12 months. It tries to be ahead of what the economy is doing. The market can serve as a leading indicator of the economy. So let's see how that looks. So here's a graph of the economy, which is the blue line. And then the dotted red line is the stock market. So as you can see, we go from expansion, and then we have a peak at the top. And then we have a bear market. Then we have some sort of recovery, the beginning stages of recovery. And then we have a full run on a bull market. We reach another peak, and then we start the cycle over again. This would be the market cycle, and this would be the economic cycle, which goes from expansion, peak, recession, recovery, and then back to expansion. If you look at these two lines, you can see that the stock market leads it. The economy follows what the stock market is doing. So looking at the stock market is a good indication of what the economy could possibly be doing. So if we're in a bull market, and usually when we come out of a recession, the early stages of recovery, you're going to see tech, you're going to see financials, you're going to see those sectors start to lead. The reason that being is because interest rates maybe have come down. Excuse me. They're able to get loans and expand their businesses. We have new startups that are able to expand their businesses. That works for the banks. That benefits tech also. So you'll usually see tech as a leading indicator, financials, and then you'll start seeing XLI, right? New things will start being built. They'll start new projects. They'll get loans from banks to fund new projects and buildings and things in that matter. So that's something to look out for when you're trying to predict the next stage. When you start seeing certain sectors start to have a recovery, it's a good chance that the economy will follow what the market is doing. Okay. So here is another diagram of the economy, the cycle. So in phase one, in expansion, the outer performers typically is technology, financials, communications, and consumer discretionary. And as we move up, right, we have less fear. As we move up, the economy is doing better. People are spending more money. They're traveling more. They're building more. So energy and materials tend to benefit during this time. We're usually at a stable economy at this time. And then we begin to retrace, which are early signs of a recession. Here is where your healthcare, consumer staples, and utilities will outperform. Once again, you still need healthcare. You still need to buy groceries and the things, your essential needs. You still need to do that, and you still need to keep your lights on. So they tend to benefit in early recession stages to the recession stage right here. And as we start to have recovery again, real estate and industrials begin to benefit from here. And then it starts over. And then you have again the technology, financials, and so on and so forth. So it's literally a cycle. And this cycle is usually between 5 to 10 years. So when we had COVID going on, it's not necessarily a shocker, right? This happens every 5 to 10 years. Something comes out. So after we rebound from COVID and our economy is doing great, we're back to optimal operations and we're flourishing. In 5 to 10 years, something else is going to come out that we can't foresee right now. It happened in the 70s, happened in the 80s, the 90s. It's going to happen every 5 to 10 years. So this sector rotation allows us to, obviously we can't predict what happens next, but it allows us to go through the whatever is happening. It allows us to leverage how we're going to operate through that time, right? Most of the stuff is hindsight, but if we know what to do ahead of time, we know how to deal with it. So if we just go to a boom, government shutdown, the economy is just doing terrible, we know that, okay, maybe I should move my money over to utilities and healthcare until they figure this thing out. And when I start seeing some signs of recovery, I know, hey, I want to invest into technology, maybe some startups in tech or tech that has big visions. They have very innovative ideas. They just need the funding to expand on that. So maybe I want to move my money from healthcare or utilities to tech now, right? So that is how we get into those realms. That's how we can stay ahead of that curve. Let's see. So how you can check on how these sectors are performing is you can use sector SPDRS, sector spiders, and this shows how each sector is currently performing. Now you can look at the day, the 5 day, the week, the month, the quarter, the year to date, the year, and that can kind of give you an idea where the money is flowing, right? So this picture over here, this is the quarter. So over the last quarter, money has been coming out of XLP at a rapid rate, out of real estate, right? You can see these are the leaders of where money is not at. So you can either short those sectors, or you can find where money is flowing into and go long on those sectors. And if you're an investor, this is highly beneficial. You don't want to be investing in something that everybody is selling they're selling their shares of, unless you're getting at a discount and those stocks have potential to go back up to where they previously were. You don't want to be investing in something that's not worth what you see it in the long run. This on the right side is the monthly output of these sectors. So as you can see, this month, even though it's a new month, in the last month, utilities have been outperforming, real estate has been outperforming, and you can kind of keep track of these and see, you can follow the money up. At some point, utilities look like industrials. It was a very small gain. But if you pair this with the charts, you can see, what's that next boom? What is it setting up for? You pair utilities with this. Let's say you had a hammer on the month, right? And you're like, oh, utilities might take off soon. And then you start seeing that they're outperforming every day or every week. You can follow the money that way, and that helps you get in on the move before it happens. Okay. So like I said, this is an introductory of the different sectors and sector rotation. I really want you guys to understand the sectors first before I move on, what they consist of, what tickers are in those sectors. Back to sector SPDRS, you can go to that website, you can click a sector, and if you go to holdings, you can look at what stocks are in those individual sectors by weight. So you can see what's the highest weighted ticker in XLK. You can go find that. You just go to that sector, you click holdings, and then it should already be from highest weighted to lowest weighted. But if not, then you just click weighted, and then it'll go from highest to lowest. So yes, that's where we are at now. The following class, we will dive deeper into it. We'll look at some different strategies and how you can really, we'll look at it on a chart also, so you can see how you can really follow the money, and you can get ahead of the curve. You can start stalking different tickers and sectors to see, hey, money is flowing out of financials and it's going into energy. Let me see what the chart looks like. You will learn, I'll teach you how to pair those things together. But as of right now, I want you guys to watch this video as much as possible, as many times as possible. Learn the sectors first, know them by heart. If you need to create flashcards or whatever you need to do to help you remember them, learn what are the top tickers in those sectors, and really get those down. So are there any questions so far of what I've gone over? And like I said, I will feed you the rest in the next video, but I want you guys to have the basics down first before we move on. So do we have any questions so far?
I just have a comment that may be helpful to everyone. The way you set up your trading view, I've done that. And so everything is by sector and what's in that sector, and it helps because you're looking at it every day.
Yes.
And so that helps you learn. And then, you know, over the title, I put consumer discretionary, what percentage it is, so that every day I'm looking at that and you just begin to memorize it.
That's smart. I don't even have the percentage on mine. But what I will do for you guys, I will drop my my list in the group. So all you have to do is follow it. And if you want to take something out, you can take it out. If you want to add, you can add. But this is literally when I'm charting. I know you guys ask a lot, you know, like, what are you looking at when you're charting? This is literally what I'm looking at. So if that helps you guys, I'll drop that after this class so you can just add it to your trading view. And you will be able to get a good overview of what the market is doing. And then you can start finding sympathies to those bigger ticker names if you don't want to trade them. Do we have anybody else? I know it was pretty quick today. I didn't want to hold you guys. I really want you to digest this information first before we move on. Nobody else?
I do have a question. I know it's probably a little bit kind of going past the sectors, but when you look at particular ETFs, like let's say JETS, how does that work into, I guess airlines would be under industrial, correct?
Yes, but okay. So actually, you're not going too far, and I can touch on it. These are just the ETFs that are in the S&P. There are literally millions of other ETFs. So JETS is an ETF by itself that you can look at when it comes to airlines. I want you guys to write this down. So the website that you want to be looking at is, if you know the ETF, but you want to find the ticker, then the website you want to be looking at is ETF.com. Okay. Now, if you know the ticker, but you want to find the ETF, the website you're going to be looking at is ETFDB.com. Okay. So as he said, like JETS, if I know, like if I'm looking at AAL, right, and I want to see what AAL is doing, I can go to ETF.com because I know the ticker. I mean, I know the sector, the ETF. I'll go check out JETS, and then you can see all of the different ETFs that hold that ticker. So it's not just JETS. There'll be like 100 other tickers. Now, usually what I do is I try to stick with the ones that I know, like that are familiar to me, because you'll literally be there all day if you look at every ETF. I try to stick with the Vanguards, the iShares, the things that are familiar to me. So yes, again, the first one is ETF.com, and the second one is ETFDB.com. And those are, y'all can play around with those. And obviously sector SPDRS.com.
So to follow up with that, so would you look at the sector first and then kind of go down to an ETF? So would you look at see how the industrial sector is going? Then if you're looking at airlines, then you kind of go to jets to see how those are performing and then kind of pick a ticker out of there.
Absolutely.
Is that the process?
Absolutely. That is exactly how it is. And even my watch list is set up like that. So I'll have XLI, and then I will have a let me see if I can pull it up actually. So for industrials, I have XLI, and then I have IYJ, which is iShares for industrials ETF. And then I have VIS, which is the Vanguard Industrials ETF. And that's literally how I do it. Exactly what you said is exactly how I do it. Where's it at? Oh, sorry. Industrials. Charting list. Nope. It is sectors. So can you guys see my screen? Can y'all see my charts?
Yeah.
Yes.
Okay.
Yes.
So what we were just talking about, XLI, and these are in ABC order. So yes, XLI I have at the top, and then I have the ETF right here. Then I have this, and then I have the tickers in highest weighted to lowest weighted. So RTX is leading, then I have UPS, Honeydale, CAT, UMP, things like that, and it just keeps going. So this is how I have mine set up. So when I'm looking for plays, I can literally just like, hey, let me check on what XLK is doing, right? And obviously I would be looking at like QQQ, NASDAQ, and things like that. I have that at the top of the screen. But yeah, I can literally just go down the list, and they're in highest weighted to least highest weighted. So yeah, that is my.
And you went in and added those individually?
Yes, I did add these individually. But like I said, what I can do is I can share this list with you guys, so you can make modifications however you like to have it set up. But this is the meat and potatoes, pretty much.
That'd be great. Thank you.
No problem. And while I'm here, I'll show you the websites. So this is ETF.db. So if I wanted to look up, let's say I wanted to look up Tesla. Actually, let me see. So these are the S&P ETFs. These are the different ETFs for like those sectors. So this helps you, like some of these aren't going to be very relevant to what you're looking for. You kind of just have to play around with them. Like I said, I look for the ones that are familiar, like ARC, iShares. I don't really see Direction all the time. So like I'm not really paying too much attention. But you can also look to see what sectors hold the most weight. Like what does that sector hold the most weight in that ETF? So right here we have XAR. I can see that it has a pretty high weighting in that ETF. So that is something that I would pay attention to. And let me check the chat. Okay. Do we have any other questions, comments, or concerns? Anybody want to look at the sectors and find like another way to remember it, or, you know, break it down a different way so it sticks? Or are you good? You guys good? All right. If y'all cool with that, then we will close it here and we will pick back up next week. We're also going to have our Q&A on Thursday. So if there's any questions that was not addressed here, you can ask them there. Also feel free to DM me or one of the other providers for any help. But thank you guys for coming out this weekend. Please study up on this. If you aren't caught up on the other videos, take time this weekend, take time this week to really catch up. You don't want to be left behind. Try to stay on pace with the videos so you can ask questions as they come, and you could just keep progressing at a steady rate. Okay. So once again, thank you guys for coming out, and you guys enjoy the rest of your weekend. Have a blessed and safe weekend. See y'all.